Hello, fellow Rebel Capitalists. Hope you're well. I'm here with my good buddy, Larry Lepard, and we are going to have a friendly debate because there's a few things that Larry and I definitely see from a philosophical standpoint. I think we're probably twins, Larry.
Very close.
You'll have to forgive me. I've still got this cold. But as far as interest rates and the dollar and maybe even sound money, I think we've got some different views. So I invited you on, not to have a winner or a loser or anything like that, but really to go over these ideas to get people thinking. That's my whole objective whenever I debate someone like you or Lynn or someone like that. It's just really to get people thinking. I don't see any downside to that, Larry. So hopefully we can achieve that objective today.
I think so, for sure.
All right. So let's go over kind of your worldview, how you see 2024 playing out, and then what that means for the dollar, what that means likely for the entire curve. We'll talk about the front end, the long end, maybe what the Fed's going to do, and then we'll just kind of riff on that.
Yeah, sure. So first of all, I would say everything I'm saying is not investment advice, and there are no certainties in this world, right? It's all just kind of probabilities. My view is we had an enormous. I mean, I deal in kind of multi-year timeframes. I'm not a trader. I'm not looking at the next 6 months as much. And I think sometimes George and I have differences that are more based on what's likely to happen sooner versus later. Yeah. And so I tend to really take a longer term perspective on this stuff because my time frame is 3 to 5 years on these investments. But saying that as a background, I think we kind of had a peak deflation in 2020, March of 2020. Long bond, the 10-year hit 50 basis points, 17 trillion of negative debt in Europe. I mean, 40 years of deflationary events, and, the list is long, the China price, shale oil, all kinds of things, labor productivity, et cetera, et cetera. Okay. I think that all changed. And obviously we went from a world that was deflationary to a world that was extremely inflationary based on the Cerveza crisis and the government's aggressive response to that, both monetarily and fiscally. And arguably the fiscal was more important than the monetary, and George and I agree on that. Okay, and so we quickly ramped CPI up to 9%, and it wasn't transitory when it went through 3 or 4; it went to 9. But they slammed on the monetary brakes. They brought it all back under control to a degree. We're now printing in the 3s and probably headed lower because the OER is going to factor in over the next year or two. And so, in my view, the Fed has now, in their mind, I think, achieved their objective. I don't think they've really achieved their objective in terms of taming inflation, but I think they do. They believe it. And I think the market believes it. I think, George, you would agree with me that, the 5x5 swaps and guys like Rosenberg and really smart guys all kind of believe in a soft landing, and that, the Fed's going to do a good job here. They've landed the plane. They've brought inflation down. It'll get back down to their target in the next year or two. And, they've managed to skip a recession and everything's going to be good. I don't believe that. I think that's highly unlikely. I think we actually are probably technically in a recession, but because of the way they do the numbers, it may not be showing yet. And I think that we're at the cusp of a bigger problem, which is the debt markets. And I think we're going to discuss that a lot. And that really comes down to the issue that we ran an almost $1.7 trillion deficit this past year. In a full employment economy with 2.8% GDP growth. So, and that's kind of unheard of. That's a big number for a healthy economy, and it's only likely to get worse if the economy slows. And I think there's beginning to be evidence that it is slowing. But the reason it's taken a while for it to slow, and this goes to a chart that's in my quarterly, which we could reference.
I can pull that up. You want me to go to that right now, Larry?
Yeah, I want you to go to that now. Page 16.
Which page? 16.
Page 16. Okay. Yeah, you'll see. Take a look at this. That's U.S. federal government spending that occurred, from the 70s to present. Notice the jump that we took in 2020. That was COVID. And notice how it hasn't come back down. I mean, that was a crisis. I get it. They had to spend a lot of money. But you would think that, okay, crisis is over. We'll go back to the baseline. Well, no. We have not gone back to the baseline. It was 6.1 last year. We're running higher than that this year. So, to me, that's why the quote-unquote recession has been somewhat delayed. The government has made up the balance. And my assumption based on that is that ultimately what's going to happen here is, the bond market is going to be where the problem occurs. And I think George and I slightly disagree on how it's going to unfold. But my belief is that over time, even though interest rates have come down and will probably continue to come down based on the Fed jawboning and the shift to what I believe will ultimately be QE. We know they've said QT is going away. Lori Logan hinted at that. I think ultimately they'll have to get to QE. That'll probably be later in the year. And in the interim, I think they've got to bring the short rate down, the federal funds rate down. And what's signaling that, and I rely a lot on a guy I respect, Jeff Gundlach, who says really the Fed funds rate kind of tracks the 2-year rate. And if you look at the 2-year rate, it's come down very sharply in the past 6 months. So I think the Fed, and it was really kind of stunning to me because as early as December 1, Powell said something along the lines of, it's premature to be talking about rate cuts. And then 13 days later, he has a press conference where, the dot plot shows three cuts as kind of a consensus within the Fed board. And also that he said, to Lori, he said to the woman from Yahoo Finance, we're going to have to start cutting before we get to the 2% inflation rate, and so to me, that was the beginning of the pivot. And I think that pivot will continue. And while I don't disagree, as George says, that rates could continue to come down for some time, both in the long and the short end, I don't think that condition will last because I think the Fed is going to be forced ultimately back into monetizing the deficits, which I think are really the core of the problem. So I'll stop there and let George react to that.
Yeah, so I totally agree with the hard landing, and I'd also dovetail on your point and just have people go through a quick thought experiment. If you're Jerome Powell, you want to be remembered as Paul Volcker and not Arthur Burns. And if you think about the 3 options here, you've got no landing, soft landing, and then hard landing. Okay, well, everyone's assuming that Jerome Powell wants a no landing, but I think that's inaccurate. Because if you think about it, that's the only option where he risks being Arthur Burns. Because if we have a no landing, we were talking about this before we went live, Larry, we would likely see the long end of the curve start going up. Well, that's inflation and growth expectations. So that means that there's a higher risk of inflation reaccelerating, which puts him in the Arthur Burns camp when it comes to history. So if you think about it through that lens, a hard landing, and he looks like a winner.
Correct.
Hard landing, and he goes down in history as the guy that had the balls to break the back of inflation, just like Paul Volcker. So now, maybe he's completely ignoring that, but I find that hard to believe when you've got a guy that's worth $100 million. He's 70 years old. And right now, at that point in your life, you're thinking about legacy. You're thinking about how you're going to be remembered over the next 500 years and how your grandkids are going to remember you and their kids and so on and so forth. And so, again, that no landing risks a reacceleration. It basically risks Arthur Burns, or the hard landing, and you're in the Paul Volcker camp.
Right. And I hear you, and I don't doubt that that's what he's thinking. I think the problem is he got a tap on the shoulder and from Janet, and perhaps even from Biden. And it's interesting because I think Luke Groman framed this very well. It's not really a choice between being Paul Volcker and being Arthur Burns. It's a choice between being Arthur Burns and being Benjamin Strong. And Benjamin Strong was the Fed chairman in the 20s and 30s who was too slow to loosen monetary conditions, which led to some of the depth and length of the Great Depression. And so, my view is, as you and I both know, the Fed has 3 mandates, right? Full employment, price control, and the unstated third mandate is functioning financial markets, continually functioning healthy financial markets. And we know the third mandate exists because we saw in many, many cases where there were unfunctioning markets, they would step in and do whatever it takes. And I think I cite as the two supreme of examples of that. One is March of 2020, when the bond market almost went no bid. And the other is the repo blowout in 2019. And, where the original Powell pivot. And so I guess the point I would make is, you're correct, George. That would be what you and I would do because, we're intelligent guys and we would care about our legacy. I think at the end of the day, he's a lawyer and he's a little bit of a political animal. And I think that he's concerned that if he goes that route, it gets really disorderly. I mean, we've seen some things happen. We've seen the Lori Logan statements about financial conditions. There are a lot of signs, and I'm by no means a good financial plumber. I mean, I look at Lynn and I look at Luke and I look at, Joseph Wang and others to give me more clues on what's going on. But the SOFR blowout and some of the other things would indicate to me that they saw some stuff that scared them. And that's why they took the steps they took in December. I could be wrong about that, but that's
no, but I think we're saying the same thing, because for Jerome Powell to pivot and risk,
right,
it has to be real bad. That's my point.
That's right. Yeah, I totally agree with you. Okay, then we are saying the same thing. I thought you were saying ultimately he would not pivot. And,
No.
Yeah.
No, I think he's definitely going to pivot, but that just shows you how bad it actually is under the hood.
Well, that's correct, and it really goes back to the basic math. I mean, if you don't mind, if you refer back to my quarterly again, and this is going to be up on my Twitter feed in a few hours after we finish this call. Go back to
which page?
Page 6, please.
Okay.
This is a great chart by, and I know you're business partners with her, Lynn Alden. And, this is really, to me, this is the core of the issue. You can see here, the total debt, total U.S. debt, all factors. And underneath it is the base money, which the Fed has some control over, admittedly, the multiplier in the banks and so on and so forth. We all know about that. But the point is, as the blue line gets too far away from the orange line, they have to increase the orange line or else something breaks. Right. And that's what we've seen historically. The first case of it was 2008. The second case of it was 2019 and then COVID. And we're waiting for the next evidence, the next piece of it, but it's coming. Right. It's definitely coming.
So I think this gives us a good opportunity to disagree a little bit, because although you can't dispute Lynn's chart, I would say, does it matter? So let's just assume that the Fed's balance sheet goes from, and more specifically, the reserves. I think that's what is most important. But let's say bank reserves go from 40 billion in 2007 to, let's just say they're 3 trillion right now, and they went up to north of 4. Does that matter? And if so, why? Right? Meaning, does it matter to the dollar? Does it matter for inflation? Does it even matter for M2? And as we know, we saw this huge increase in the Fed's balance sheet during QE 1, 2, and 3, and it didn't really result in any type of significant consumer price inflation. I think we both agree that the inflation rate is a lot higher than the government admits to. But still, we didn't see like 1970s or 1940s type of inflation, even though the Fed's balance sheet just completely blew out. And then if you look at a chart of the DXY, which I think I've got
went straight up. Yeah, no, I know it was positive.
Yeah, the chart. I mean, if we look at let's say the start of QE, we're right around 81. Just using this as a proxy, not necessarily for consumer prices in the U.S., but against other foreign currencies. And we've gone straight to 103, and that's with the Fed taking their balance sheet from 40 billion up to, from 800 billion overall balance sheet up to what, almost 9 trillion
now. And, 3.8 after 2008. Yeah, no, you're right.
And then also too, if we look at the chart that you pointed out from Gunlock there, let me go back to that. That's 16, I think. That's where we saw the deficits just completely blow out, which we both agree. Look, they're going to get worse. I mean, it is what it is. And Josh, remind me when we get done to send Larry a chart of government spending to GDP, because what you'll see, Larry, is the percentage of government spending to GDP goes up every single time we have a World War I, a World War II, a GFC, a coronavirus, something like that. And it comes down slightly, but it never goes back down to where it was prior to the crisis.
I have part of that. I have that from 64 going forward. Go to page 7.
I've got it all the way back to like the 1800s.
Oh, I'd love to see that. But go look at page 17 and you'll see it. And we're at the highest level ever. What I don't have here is World War II, where I think it actually was a bit higher. If you go to page 17,
government spending.
Yeah.
Now I want to point out, Larry, this is federal.
Right.
What I do is I look at state and local. And state and local right now, we're getting close to 50%.
Oh, wow.
Yeah.
So, but let me address something. You made a great point. We had a lot of QE, and I, by the way, I got caught in this. I lost a lot of money. I look like a total idiot from 2008. No, I did. I mean, I'll admit it. It's easy to do. From 2008 to 2013, I was one of those guys who said, "Oh, this QE, we're going to have hyperinflation." They're printing money like crazy. what I missed was the transmission mechanism, which is the banks, as you know, and the lending. What I also missed is that all that printing actually went into assets. And it did that in large part because, we had the China price going on and a lot of other positive things, shale oil coming on, et cetera. And there just wasn't any traditional, quote unquote, inflation pressure in that time frame. So the money got created. It's just that the money didn't chase goods and services. The money chased assets. And that's why, of course, we had the housing boom and so on and so forth, right? The dot-com boom, and when it created what, in my view, is kind of the everything bubble, that we're now in the process of living through the bursting of the everything bubble. I mean, to me, the greatest financial crimes of the last 20 years are ZIRP. I mean, the notion that the cost of capital is zero, and the Fed was willing to do that long beyond the time at which the crisis occurred. I mean, I get it. In 2008, the ATMs aren't going to work. Okay, fine. We need 800 billion. Let's do ZIRP. But they continued ZIRP until 2016. That you just can't have a capitalist system working when you have money as free. It distorts everything. And we are still, in my opinion, living with the after effect of that distortion and trying to figure out what it means. It's tricky as shit. And, very smart people can completely disagree on whether we're going to have inflation or not, and both be partially right. I mean, it's unclear, right?
Yeah. What I wrestle with a lot in the whole ZIRP era is, if we would have had free market rates, would they have been different?
Interesting.
Because if you look at the long end, it was very, very low, which would, to me, if you're looking at Irving Fisher growth inflation expectations, if you've got I don't know where it was, but let's just say the 10-year treasury was trading around, let's just say 2%, something like that.
Yeah.
You take out the Fed, it probably would have been zero, but would it have been 25 basis points, 50 basis points, something like, I don't know. Obviously you can't prove a counterfactual,
right?
But I don't know that rates would have been 5%.
Very possible. I mean, certainly the economy was sunk. I'll give you that. Yeah, there's no doubt.
Yeah, so that's what I wrestle with there. Now, going back to your earlier point about the financial economy getting the bulk of the bank lending, which is how I would phrase it. I completely agree. I don't think there's any disputing that. But what I would argue is that it wasn't really due to the expansion of the Fed's balance sheet. The Fed could have taken it up to 9.53 trillion. That didn't really matter. What mattered was the bailouts. And I would go all the way back to long-term capital management. Because if I put myself in a position of a bank, and I'm coming at this from the standpoint of they have an infinite balance sheet. They create their own liquidity. They create their own assets. They create their own liabilities. They don't need the Fed to settle all these things. And I've got an option right now. Now it's 2010, let's say, or 2011. Right. I can either lend into the real economy to create goods and services, but I take a substantial amount of risk there. Or I can lend into Wall Street, and I know that they're all going to get bailed out if we have an issue. I can lend to the S&P 500 for them to buy back their shares. And I know that my downside is effectively zero because I'm lending to the guys that are going to get bailed out. Yeah. And therefore, the bank's balance sheets expand. They issue loans. But for the average Joe and Jane, their interest rate is effectively infinity because they can't get a loan. As an example, Larry, I retired in 2012. And I started buying real estate in Kansas City and whatnot, these little single family rental properties. And I was buying them cash. So I had like 15, 20 of these things that I had purchased in that first year. And I had them all rented out. I had them all remodeled, rented out. And this wasn't in the ghetto or anything. This was in really, really good neighborhoods in Lee Summit and in other areas, Blue Springs on the Missouri side of Kansas City. And I went to the bank, not even to get like a cash out refi, just to get a line of credit against these things. And I had like a 780 credit score. I had all this money in the bank. I had all these properties that I owned 100%, and they were all cash flow. I had them all rented out at like $1,000, $1,100 a month. And the banks just told me to pound sand.
Wow.
They said, no, I was trying to get a line of credit, Larry, for 40% LTV, 40% on all this equity. And they told me to jump off a cliff.
Yeah.
Meanwhile, the Black Rocks and the Blackstones and all, they're sitting there borrowing money right and left at
Yeah.
10 basis points
Right.
or whatever it was, right?
Yeah.
So that's kind of an anecdotal story that I would use to kind of back that up. That when the problem with the Fed there wasn't the size of their balance sheet, is that they created the moral hazard by bailing out the system to begin with. That was the real issue.
I completely agree with you. And that's a great point. I was not aware of that anecdote and that issue taking place. And it was because they were looking in the rearview mirror. I mean, they had just gotten burnt terribly on real estate loans. And so they weren't going there anymore. Right.
Yeah. And they're looking at me and you're like, why should I lend you money? You can go bust.
Right.
When I could just take this loan and I could lend it to Larry Fink and he can't go bust, because what we've seen over the last 15 years proves that at the end of the day, whether it's the Fed or the government or whatever, they're going to bail out Larry Fink. They're not going to bail out George Gammon.
And then it even probably got worse for you, because at least when you were starting, you probably weren't competing with Larry Fink to buy those houses. But probably 5, 6, 7, 8 years later, you were in there bidding on those houses, and Fink was right beside you bidding with you, and he had a hell of a lot lower cost of capital. I don't know when that bid came in, but it did come in at some point, right?
Right around 2014, 15.
Yeah, right. Yeah.
Yeah, so I saw, because I was going to I was buying these tax foreclosures, Larry, where the county would foreclose on people for not paying their property taxes. Right. And the first one that I went to, I bought 6 properties. This was August of 2012, and it was me and about 10 guys.
Yeah.
And fast forward 2 years, and there's literally 500 people there.
Oh, is that right? Wow.
Yeah.
And how many of them were Wall Street financial players? A big percentage, right?
It was their representatives.
Sure, fair enough. But yeah, and again, you couldn't compete with them because their cost of capital was close to zero, and yours was your own equity. Yeah,
exactly.
Yeah, the system is horribly broken, as we both know. And
so anyway, the main point there is I don't know that was, the Fed would have taken their balance sheet to 1 trillion. I think you would have had the exact same thing. Another thought experiment that I always use is I say, okay, let's say we would have had QE, but they would not have bailed out long-term capital management.
Okay.
Would the stock market have gone up? And I'm like, I don't know. Another thing too, let me show you a chart, Larry, is I always reference this. This is the amount of reserves in the system. And this is something that I don't know why more people don't talk about. So, that this is not the Fed's balance sheet. This is just bank reserves,
right? Just
bank reserves, which most people, financial experts would call the quote unquote liquidity. Right. Okay. Well, if we go back here to 2007, we're or 2008, really 40 billion with a B, but you can go back to 1980 and it's the exact same.
Yeah.
It's 40 billion. In fact, you can even go back to the late 1940s, or excuse me, the late 1950s here, and it's around 20 billion. Right. So my point is, and by the way, I don't know what M2 was back here in 1960. I would assume that it would have been around maybe 300 billion or something like that. I know in 1980 it was 1.5 trillion, and 2007 it was 7.5 trillion. So if you've got M2 going from, let's say, 300 billion to 7.5 trillion, and the bank reserves are basically the same, what that tells me is the banks don't use bank reserves.
Right.
Plain and simple. So if you add another 2 trillion in bank reserves, it doesn't do anything, because the banks aren't using them to begin with. I think what really matters there, and where again the Fed comes in and the central planners, is risk, perceived risk. If you have a static level of perceived risk, I don't think it matters what the Fed does, because the banks are going to do what they're going to do. They're going to produce their own liquidity. They're not even going to use the Fed's balance sheet. But if risk goes up, then I think the Fed's balance sheet does matter. Like BTFP would be a great example of that. The whole system would have blown up if they would not have come out with BTFP.
Correct.
And therefore, that did matter. But again, I don't know that it mattered from a standpoint of the size of the Fed's balance sheet, more so just because it was a bailout, and therefore the risk went from way up here back down to there. So the banks would start using their own balance sheets and creating their own liquidity again.
I think what you're describing eloquently, and in a way I hadn't just looked at before because I wasn't familiar with those bank deposit numbers, reserve numbers, is just how pervasive and important the Fed put is, right? I mean, there's basically the financial system basically knows it's got a Fed put, full stop.
Yep.
And they can do whatever they want to do. And I thought the BTFP was very fascinating because if you remember the time frame clearly, Janet Yellen flip-flopped. I mean, there were a couple of times there where she was saying they might have to guarantee the entire $17 trillion deposit base.
Yeah.
I mean, that would be a big deal, right? I mean, and they were deeply concerned, when that whole thing went down. And by the way, I don't think they're totally out of the woods on that particular issue.
No. I was looking for a chart. I think I've got it here, Larry. Of the go ahead and keep talking, and I think I've got the BTFP.
There's a great guy on Twitter, Triple Net Investor, who portrays all these buildings, all these CRE buildings that the regional banks hold the paper on. And I mean, there are many, many, many significant, $50 to $100 million, $200 million real estate assets throughout this country that are selling at 25 and 30 cents on, the high price.
Right.
And the paper on those banks paper on those properties is held by the banks. And, in fact, that's in my report as well.
And so this is another area where we may slightly disagree, because I totally agree with you that the banks are screwed and commercial real estate is going to blow up. I don't think we're in inning 9 or we've got past this regional banking crisis. I think we're just in inning 5 or 6, and this is going to play out probably in 2023. I mean, the BTFP is skyrocketing, and I don't think you can contribute all of that to just that arbitrage play that people talk about.
Yeah.
But I think that where was I going with that? Well, keep going, then I'll circle back here.
Yeah, go to page 22. You'll just see the size of the unmarked losses on these regional banks.
Oh yeah, that's where I was going with it, Larry. Sorry, I think that if the banking system is in trouble, that means that money's going to get tight, regardless of interest rates. And if money gets tight, that means liquidity gets tight. And if liquidity gets tight, we have what Snyder would call deflationary money. You have the velocity slow down, right? And in that environment, assuming we have this extension of the banking crisis, I don't know how we have a reacceleration in consumer price inflation, because at the end of the day, it's the banks creating the money. Now, you could argue that the government will come in with deficit spending that will be monetized by the Fed. But again, their balance sheet could go to 20 trillion. And if the banks aren't lending, the banks aren't lending. And I don't know. So that may be something we might want to riff on as well.
Yeah, we should. I mean, it's a very good point, and you caused me to question my assumptions because we had a conversation about this pre getting on the live stream. I mean, it's a very good point. I mean, I guess where I would slightly differ is I do believe that the pain will get to be significant enough that we'll go back to STIMIs and UBI and YCC and all of that stuff.
I agree.
If you look at, I was on a call yesterday with Rosenberg, who's very, very smart, and he made the point that, hey, I don't see the driver for the inflation. I just don't see it without monetary creation, and he didn't think that we were going to have another bout of monetary creation. And this goes back to Lynn's original chart, which is I don't see how we get away without having another bout of monetary creation. I mean, I think things start to break, and by definition, the Fed is the put. And so by definition, whether it's the BTFP or who knows what they're going to call it, they'll create something new. And, we will have quote unquote STIMIs, and we will have, checks sent out to people. We will have UBI, et cetera, et cetera. And also we'll have, a substitution effect so that whether the economy goes up or down, let's set that aside for a moment. The biggest thing I'm playing with, because I'm managing a fund, is where are these big pools of assets going to go? There's 700 trillion of assets in the world. Some of it's in bonds, some of it's in stocks. If you look at the two categories that I focus on, gold mining companies and Bitcoin, there's probably in tradable gold, there's $13 trillion of gold in the world, but a lot of it's around women's necks in India and in vaults that don't move. Central bank gold. Tradable gold is about $3 trillion. All the professional gold mining companies in the world probably have a $300 billion market cap. I mean, Tavi Costa can tell you the exact number. And, the Bitcoin market cap is $800 billion. So, what I see is a substitution effect of as this monetary irresponsibility that is almost inevitably going to happen starts to unfold, people are going to say, you know, I don't need to hold these bonds. And I get how a slowing economy, you know, I think you believe interest rates could come down. And I don't disagree that in the short run they could. I think in the longer run, people understand that the monetary system has created money roughly at 7% a year for, you know, 50 years. It's going to continue to do that. And as it does, you're just not getting paid for taking the risk in bonds. And so you've got to be, you know, in these other securities, and whether it be gold, silver, you know, gold miners or Bitcoin, or even equities to a degree, because they'll reprice in whatever the new monetary, you know, medium is, if assuming we go to a new monetary medium. But, you know, I mean, to me, the big sucker at the table is the bond market. And I think the world is kind of starting to figure that out. I think we're on the cusp of figuring that out.
Yeah. So where I've got a different view is probably the main components of demand on the treasury curve.
Mm-hmm.
So it's absolutely true that you got some people like retirees or something like that, pension funds maybe, that are buying treasuries just to get that yield for the next 10 years,
right,
or the next 30 years or something like that. And I totally agree. They're going to get wrecked. I don't think we're having a 1970s, but I agree with Lynn on how it'll likely be the 1940s, where that additional money supply creation will come as a result of government deficit spending and the Fed with M2. And I think even more so price controls and other things that we saw. CBDC, I think that's another thing that is going to drive inflation moving forward. I don't know that it's just strictly the deficits, but I know you lost my train of thought again. I'm sorry. I'm sick, Larry. I'm not feeling well. Yeah. But keep going, and I'll probably interrupt you in 30 seconds.
No. I mean, let me go back to my my report just for a second.
Yeah,
because there are a couple of other points I'd like to make that I think are important for the readers to focus on. Let me just. I'm sorry. I'm scrolling through things here.
Which page?
Go to page 12, because I think this is an important chart. There are two charts here, really. The top one is the three inflationary waves of the 70s. I mean, you know, inflation is going to, in my opinion, wax and wane. And
it always does.
It always does, right? And, you know, look, I mean, I recall in the 2019-18 timeframe, the Fed officials saying, we've got a real problem. We're not meeting our inflation target. Inflation's 0, and we want to be at 2. Well, you know, they solved that. You know, we went to 9. We've come back down to 3. Are we going to 2 or 1 or 0? Possible. I mean, Gunlock and others point to the OER changes and you know, the fact that we may come in lower, and that's all fine. But I think there are other factors in the background that are taking place. You know, and part of the reason that deflation was present for so long, there were a lot of favorable things going on. We had, you know, China enter the world with a China price in 2000. We had all the development of the shale oil from the United States in the kind of 2000 to 2023 timeframe. And we had a lot of productivity, and we had a growth, and we had a lot of technology growth. And I'm not saying any of those things is reversed forever, but they have certainly slowed down. And as we were talking before we got on the call here, you know, the thing that I see that I think is going to really push inflation, and, you know, you see it is wages and the, you know, the wage market today. I was speaking yesterday to Peter Bachfar after the spaces we were all on, and he cited 5 or 6 instances, really good instances of where people are not getting 1%. I mean, the Fed wants to return us to 2% inflation. Okay. I mean, you know, pilots are getting 12%. There's a pilot shortage right now. They're getting 10, 12, 15% a year pay bumps. You know, Peter cited an example where a guy at, you know, the Walmart warehouse managers are getting 9% a year pay bumps. I mean, you know, 9, 12, 15, even 5 or 6, those are a long ways away from 2%. And so I think we've unleashed this inflationary demon. And I think that the odds of Powell ultimately being Arthur Burns are reasonably high, because I don't think we put the demon back in the cage until we truly do have a Volcker, until we truly do have a positive real interest rate for a long period of time, long enough to break the inflationary trends that we're
that depends on bank lending, Larry.
Yeah, I agree with that.
Because I just don't, I mean, assuming that bank lending kept up with the rate of whatever nominal GDP, whatever metric you want to use, or just kept going up and up and up, I totally agree. You're going to have the wage price spiral. If oil goes to 200, that's going to be a huge input. It's just if you don't have the bank lending to match up with that, at a certain point, you burn through the margins of the airline, right? Because the airline isn't able to raise their prices because people have less money to spend. The economy is going into the gutter, and therefore, you got those margins shrinking. At a certain point, they can't shrink anymore before the entity goes bust, and all those people that got pay raises are now unemployed.
It's a great point. It's an absolutely great point, and I don't disagree with it. All I'm suggesting is that as each of the things you just described starts to unfold, the government gets more activist in keeping things alive and starts bailing out that airline or sending stimmies to people so they can afford to fly, or whatever it might be. Do you follow me? I mean,
yeah, so what I do there is I try to think through, okay, let's just say the government did come in with these stimulus checks. Let's just say that they just did the exact same thing they did in 2020, right? How much of that 9% CPI, and again, we know that's cooked, but just using that as a proxy, how much of that 9% was due to the government spending, which I would argue it wasn't really the M2, but it's more so the velocity of money changing. That's actually what I forgot to talk about, because you're taking, even if there's no QE or there's no monetization by the Fed, you're still, Janet Yellen is taking money out of savings and she's turning it into checking.
Yes.
And therefore, so therefore you've got that velocity increasing. But my point is, how much of that 9% was a result of the demand side and how much was a result of the supply side? Because it was obviously both. But if we say it was 50-50, then now all of a sudden, okay, we've got 4.5%, assuming that the supply side stays the same, assuming that the government did or will in the future do exactly what they did in 2020. And although that is higher than where it is today, I don't know that takes us to that next wave, which is what we saw in the 1940s and the 1970s. Now, I think we'll get to that next wave, but I don't know that in and of itself gets us there.
I agree with you, and it may not be higher. It may not be the same way as it was in the 70s, and I don't disagree with what you're saying. I would make, and obviously some of it was supply side driven. I would make the broader statement though, and I don't think Rosenberg did a good job of refuting me on this when we spoke about it on Spaces yesterday. We have really underinvested in stuff. Capex, I mean, Tavi's got some great charts on this. I mean, general capex into commodities and just general manufacturing has not kept pace in the last 5, 10, 15 years with what it was doing before. And some of these things are very long lag time items. I mean, there's some really great charts showing the shortages coming in copper and silver as examples. And, to start a new copper mine is a 10-year enterprise. And so, and I think the same is somewhat true with oil. You can't just turn on the taps really quickly. You can turn them on to some degree, but the point I guess I'm trying to make is if we've underinvested in capex and we've increased interest rates here, and that's the other thing, this increase in interest rates. I mean, it was one thing when rates were low, at least somebody thinking about expanding capacity could say, well, I can finance this pretty cheaply, maybe I should do it. Do you know what I mean? Well, with rates where they are now, I mean, higher, definitely at the margin. I've got to create, I've got to clear a hurdle rate. The risk-free rate's 4%. I got to add another 3 or 4 on top of that. This thing's got to pencil out at 12. I'm not going to do it. So, I think there's an argument to be made that we've underinvested in capex and that demand piece is going to continue to be a problem. I can't prove it. I mean, I'm not an economist and I can't prove it, but I do know that, there was a long period of time. I mean, if you look at, I'm an investment manager and I look at cyclical charts. I think one of the great cyclical charts out there, I don't have it in my thing, but it's easy for anybody to find. It's go look at the S&P ratio to the commodities ratio, commodity, GSCI, right? And I mean, S&P is incredibly highly valued right now. Commodities are incredibly lowly valued right now. And those things tend to mean revert over time. And so my point, I guess, would be that I think we are entering a super cycle, commodity bull market. I really do. And I think the reason for that is the underinvestment that's taken place in the last 5 or 10 years. So I think that, part of what's going to drive the 70s-like inflation, and maybe not to the same level, But certainly, I guess the point I would make, and I think you can agree with me on this, is that we're just not going back to the way things were. We're not going back to 2%, 0% inflation. We're just not. You know, I mean, the wage earners are demanding more, and frankly, they're getting it because, you know, the boomers are retiring and there aren't as many people in the labor force. And, you know, so I think we live in an inflationary world now as a general statement.
So I disagree with that, but I do agree with your overall view that throughout the 2020, I think 2020 is going to be an inflationary decade. Right. And I think that there's going to be these waves. But I think where I see things slightly different is with the backdrop of the monetary system and the banks becoming more and more fragile, therefore lending a lot less. And I completely agree with what you're saying with a long-term commodity super cycle. I talk about that on this channel all the time.
Right.
But again, it's kind of robbing Peter to pay Paul. I don't know. Yes, you're going to have to pay $6 a gallon for gas, but that means you can't buy that shirt from Walmart.
Yeah.
And therefore, that means Walmart isn't going to be able to hire as many people. The unemployment rate goes up, and you got problems there that brings the inflation rate back down. So you have these waves that, and I think but to your point, where we go through one of these disinflationary waves that may actually turn into deflation, then the government comes in, does something, whether it's CBDCs, so they can inject money directly into people's back pockets through UBI, and then the risk goes back up to where it was, or excuse me, the risk comes back down to where it was. Therefore, bank liquidity, they start lending again, and then you've got the lending on top of the components that you're talking about, which takes us to that next wave of consumer price inflation. I think that they're also going to combine that with price controls, Larry.
Very much so. Yeah.
Yeah, just like we did in the 1940s and the 1970s. And so the way I see it is you had price controls, I believe 45 and 46. They took those price controls off. And in 47, we had the CPI go up to 19%. But by 49, the CPI was at -3.
Right.
So
well,
it goes from 19 all the way down to -3, and then it goes back up. So I think that, you know, if we look back, if we're sitting at 2030 and we look back, we're probably, I mean, both groups are going to be right. The deflationists are going to be right, and the inflationists are also going to be right. It's just a matter of what time frame you're looking at.
I think that's absolutely right. I mean, they've created a monetary system that's out of control. They're bouncing off the guardrails of inflation and deflation. And I have long said that, I mean, you know, if you look at how big this bubble was, it compares really to the 1929 bubble. A lot of the conditions today are actually more similar to the 20s than they are to the 70s. And one would argue that if you're unwinding a bubble of the size that we've got, and as you point out, the banks aren't willing to lend and can't lend, you know, unless they have severe, you know, massive assistance. I mean, yeah, we should really have a deflationary world. And one could further argue that no matter how aggressive the Fed gets, it doesn't matter. They're going to get run over by the, you know, as you point out, you know, the airline, they're going to pay the higher wages to the pilot, but guess what? No one's going to be able to afford to fly, and the airline's going to go BK. You know, I mean, I don't disagree. I mean, we could have an extremely severe deflation here. And I think about that a lot in the context of my investments, because, you know, the biggest investment we have in our fund, obviously, is gold. And I look at how gold did in the 30s, and it was fixed in price, but the gold stocks went up 10x during the decade of the 30s. And in real purchasing power, gold maintained its purchasing power because the price of everything else went down 90%.
Right.
So, you know, I have a grandparent who bought a house in Birmingham, Michigan for $7,000 that in 1928 was a $55,000 house, right? And, you know, and the Depression occurred, and he had saved up his money, and they had, you know, they had a smaller house, and he sold the smaller house and turned around. And so he got a bargain, you know, because he basically was able to buy something for cents on the dollar. On the other grandparent side, I had a grandparent in Ann Arbor who was running a business who, you know, took the false inputs from the Fed in the 20s, and he doubled the size of his business in 27 because business was booming, right? And he used debt to do it, right? And he spent the entire 30s begging the bank not to foreclose on him so he didn't lose his business. And when that grandmother died as she was going through her death tremor, she kept saying, "They don't have any debt. They don't have any debt. They don't have any debt." I mean, the 1930s was an existential, you know, near-death experience for that set of grandparents. So yeah, I mean, this is what the Fed has created. They've created this out of control system that swings between, massive inflation and potentially massive deflation. And it makes it extremely tough for regular people to just try to save and, keep their feet solidly on the ground. And, the only advice I give people is just, be very, very wary of leverage in a system that's this volatile. There's a great chart on the internet that Murmacan, my friend Dan Oliver at Murmacan Capital did, that shows how volatile prices were in the hyperinflation of the 1920s. In a system that's as broken as this is, you're right. I think we're at times the inflationists are going to look incredibly right in the next 10 years, and at times the deflationists are going to look incredibly right in the next 10 years. And it's going to be really hard to keep your feet on the ground. And it's what Richard Russell used to say. I mean, in a bear market, everybody loses money. The winner is whoever loses the least.
The least, yeah.
It's going to be tough. I mean, sadly, it's going to be tough, but it is what it is. And I think we can both agree that the government is going to try and do everything they can to smooth it out. And hopefully there'll be, we will make it through it. And on the other side of it, I do think on the other side of it, what we're looking at is eventually, the Fed. I mean, I noticed you're wearing a T-shirt that says "End the Fed." I mean, there's no more important thing in my view. I look at all the battles that are going on in the world today. To me, that's the most important battle. Is we've got to get this monetary system into a sounder set of hands, because the way it's constructed right now, it just makes it impossible for all of us to plan and to build a good economy.
Yeah, it's just where I would see things different there is I don't think it has to do with the Fed's balance sheet.
Okay, fair enough.
It's just the moral hazard by them being there to begin with, because if we look at the balance sheet, I've actually got the Fed's balance sheet even going back to when it started.
Yeah.
And you see the increase of the balance sheet, but it wasn't really due to reserves other than the 1940s a bit. It was the increase in the size of their balance sheet was just simply them creating currency. And they weren't creating currency to buy stuff. As you probably know, just the mechanics behind it is when the banks lend, and they lend and lend and lend and lend, and that's going to be more demand for currency. Therefore, they go to the Fed, and the Fed sends them more hard green pieces of paper, and then that increases the size of the Fed's balance sheet. It's not the Fed buying things; it's just simply them providing the banks with green pieces of paper that are on demand for customers.
Well, yeah, right. As you pointed out, it's the put, and it's what allowed, it's what made the banks lend to the big names and not to you. And that's how the system is broken.
Yeah, I think and a lot of people accuse me of kind of, oh, well, George, you're nitpicking and you're kind of splitting hairs and whatnot. But why that's important is because when you're looking at what the Fed is doing with their balance sheet, you've got to ask yourself, does that impact the risk or perceived risk? Yes. If it doesn't impact the perceived risk at that time, it's not going to matter from a mechanical standpoint, because the Fed's balance sheet doesn't matter, because the banks don't need reserves, because they just create their own reserves. They create their own liabilities. They create their own assets, and they don't need the Fed's balance sheet to settle. So in a time of crisis like GFC, then yes, absolutely, the Fed matters in what their balance sheet is doing. BTFP, another example. But if we're just going through 2014, 15, 16, 17, 18, or if we're just going through 2022 or 2023, what they're doing with their balance sheet, it doesn't matter at all.
Yeah, but let me be devil's advocate with you on that. I mean, how would you then explain what happened in 2019? They're trying to shrink their balance sheet, and a rivet popped. Do you know what I mean? I mean, to say that their balance sheet has no impact. I mean, I look, I'm not an expert enough on the monetary plumbing to know. Okay, I mean, it's not my area of expertise, but I do know that they were shrinking their balance sheet, and the repo market popped. Right? I mean, it broke.
Yeah, I think it's similar to like a Native American rain dance. Where I'm not trying to be an asshole, but if they do the dance and it rains, then all the Indians or whatever assume that the dance is what did it. And the reason but let me back that up with some data so I don't sound like a jerk. So if we go back to that chart of reserves, and we come to the conclusion that definitely prior to 2007, the banks didn't use reserves. They just flat out did not use them in repo and anything. Yeah. So I fast forward to 2019 and I say, okay, well, if the banks aren't even using reserves, how can a lack of reserves caused the repo rate to go up to 10%. Now you could say, well, George, it changed because of the regulations, because of Basel III, or what is it, SLR, I believe.
Yeah, they changed the SLR rules. Yeah,
it changed because of these regulations. Where I struggle with that is that from all the way up until 2020, in fact, we had a 10% reserve requirement. You know, that was a quote unquote regulation that was supposed to constrain the banks and make them safer. Okay, well, again, we go from 1.5 trillion to 7.5 trillion from 1980 to 2007 with 40 billion in reserves. So where's your 10% reserve requirement there? The bottom line is the banks just gave the Fed the middle finger and said, you can go on and have fun with your stupid reserve requirement, but we're just going to create these sweep accounts, which is what they did, just to get around the regulation. Because if we want to lend, if we see a profit-making opportunity, we're going to take it. Regardless of Basel III or any of these crazy things. And if we see a profit opportunity because because of repo rates are going up to 10%, boom, we're going to take it, regardless of how many bank reserves are on the aggregate balance sheet. So my view of that is you had a spike in risk, where the bank said, I don't care how many bank reserves we have, we're not lending. We're not lending because there's some entity out there, whether it was Credit Suisse or who knows, you know, Deutsche Bank or something like that. We'll never know at the end of the day, but something in the system broke. And they're like, you know, we can provide the liquidity, but we're not going to, because the risk reward doesn't make sense unless it's at 10%. And then the Fed came in with the whatever they did, you know, basically a guarantee. And then they said, okay, let's take a deep breath. If the Fed is there, if the Fed acknowledges the problem, now we'll go ahead and create the liquidity needed. And it didn't have anything to do with the Fed's balance sheet, but the Fed coming in and just stating basically that they see the problem and they're going to be there to backstop it. So go ahead and create the liquidity regardless of how many bank reserves are actually in the system. That's my view of how it played out.
And that makes sense. That's logical. I mean, I can, and it's very possible that that's the case. I understand your point about the bank reserves not really being the key.
It's not even debatable that they played no role prior to 2007. That's just reserves, looking at the Fed's. That balance sheet.
I get that. Yeah, I mean, the point is that it's the put that really tells you what's going on. Yeah,
and it's just psychological. It's just the Wizard of Oz that they're just there. Okay, we're going to do something. You know, it's a lot like what you're saying in 2020, Larry, when they came in and they bought corporate debt. Remember that?
Yeah,
because there was no liquidity in that market or something like that. They only bought it was just some minuscule amount.
Suddenly the market, no, that's right. No, that's, I mean, and you look at Silicon Valley Bank failing, and you look at how big that was. You look at the run on those banks, and when they got in there, when they created the BTFP, and I mean, the whole thing calmed down incredibly quickly, you know. And so, I mean, what it does tell you is that the put has a lot of value, and
it does, but it also tells you that they're always behind the curve.
Well, that's true too. Yeah, that's true.
Right? They never come out with a put prior to the crisis.
No.
They always brag about how many tools they have, but they never seem to have enough tools at the end of the day. They're always creating the new tools.
They have to create a new one. They give it a new name, and there's no doubt they will create a new one and give it a new name. But, you know, at the end of the day, we can see that we live, in my opinion, in a system that's broken and out of control. And that makes it very difficult for those of us who are investors.
I agree there, but see, this is where it gets interesting, because I think that equals a higher dollar because the system's broken. And that likely puts a bit, although I totally agree that, you know, we're fast forward throughout the 2020s and we're probably not at a high on the 10-year treasury yield as we speak right now. You know, I totally agree there, but I do not think the dollar is going to crash. Now, it may crash against goods and services in the US. Absolutely. And it could crash substantially, you know, looking at my view of kind of the 1940s or whatnot. That's the dollar crashing, quite literally, you know, when you see CPI going up to 19%. But I don't know that it's going to crash against other currencies. That I struggle with, regardless of what the deficits are doing or the Fed. So let's talk about that. And then let's talk about how, you know, you see the long end of the curve maybe getting out of control due to this debt or deficit kind of doom loop. And then I'll tell you from a mechanical standpoint how I see things a bit different.
Okay, fair enough. So I don't do the dollar very much. I mean, to me, the dollar index is really just one piece of fiat garbage against a bunch of other pieces of fiat
Yeah,
garbage.
right,
So,
right.
I mean, Brent's a good friend, and I think the milkshake theory is brilliant. And I agree with it in many
But
respects.
I sorry to cut you off, Larry, but I do think that you have to look at the DXY if we're trying to predict what demand is going to be like for treasuries.
I agree with that. And I think, I mean, notably, you could see, I mean, so they started the pivot, and this is in the letter that'll be posted. They started the pivot in September, October, and what you can see is that, they brought down the 10-year, they brought down, and they brought down the dollar, equivalently. And as Luke points out so eloquently, I mean, they have a choice. Do they want to save the bond market? They want to save the dollar, and I think ultimately they will always pick the bond market over the dollar, and so the dollar has slid a good bit. And I think it's likely. My opinion is actually it's likely it's going to continue to slide, and maybe what I look at the dollar cross. I mean, the three prices I really look at the most are the dollar versus oil, the dollar versus gold, and the dollar versus Bitcoin, because to me those other three assets are. I mean, oil is the thing that everybody needs to run the economy. Gold is the longest lived, sound money alternative, and Bitcoin is the emerging, an emerging sound money alternative. And so, to me, if I want to know how the dollar is doing, I want to know how it's doing in the price of those three things. And the behavior of those against the dollar has made total sense, right? I mean, we saw 2020 occur, we saw the response, and all three of those things took off, and now we've seen, them tightening down on the monetary, creation mechanism, so to speak, as a result of the rise in interest rates. And the price of all three have been under control. But I think that what we're looking at is ultimately they will be forced to step on the monetary gas again because of the chart that I showed earlier, the Lynn chart, and whether it's into bank reserves or however it gets in there. I mean, one thing that we haven't really talked about is the Fed is just literally creating and printing money now, because the Fed loses money every year, and it's gotten up to a couple $100 billion a year. I mean, just off of their balance sheet. I mean, they're paying. They're lending short term, and they've lost a lot of money on the long bonds that they hold, and they have to eat that loss. And they used to send money to the Treasury, they don't. So there's one way that they're monetizing things. But let me continue along. I mean, I think ultimately, whether the inflation becomes very high or just medium high, I don't know. I don't think anybody really does. But I think that the odds are good that the government will continue to and be forced into a situation. I mean, what we see going on is, and this is the most interesting thing to me, the U.S. government is starting to look like a third world country. I mean, we're starting to get to the point where, the interest expense, is eating up just too large a position of, the tax revenue. And unless they either cut expenses or increase taxes, there appear to be no appetite for either of those two things. They're going to have a problem where they're going to have to literally print the money to pay the interest expense.
But you're assuming that there's no demand for treasuries in
Well,
that environment, not no demand, but you're assuming that demand goes down. And where I have a different view is, let's assume that everything that you're saying is right as far as what the Fed will do and the government, and I totally agree with that. But if they are doing that, then they're doing it because we're living in a deflationary environment where velocity of money globally is slowing down.
Correct.
And in that case, that would be dollar bullish. And in that case, that ironically enough, that is putting a demand for treasuries. So the fact that they have to do that tells you that we're in an environment that overall is risk off, especially outside of the United States. And in that environment, people or huge entities, pools of money, are going to gravitate toward the safest asset, which is, whether we like it or not, the treasuries.
I hear you. And I think the view on the treasuries are changing. I think they're actually starting to trade more like a risk on asset. And I think, I mean, I don't disagree with what you've described at all, George, in a 6 month to 1 year time frame. But I think in a longer term time frame, unless we see, and it's a big caveat, unless we see a cut in expenses or a rise in taxes, I don't see how they make these treasuries money good. I mean, I think the people. I mean, yes, I get why people are buying a treasury if we're in a deflationary environment, where prices are literally going down and we've got deflation everywhere. I mean, there's no doubt that the U.S. government is going to pay out on those treasuries in nominal terms. There's just no doubt about that. And if you really believe we're going to have deflation, of 4 or 5%, well, a 4% yield on a 10-year or a 20-year or 30-year, that's a good bet, right? But I think what the market is saying, what I believe the market is saying, and I look at the other assets that we talked about earlier, is that can't last. I mean, yes, we can get a big deflationary impulse, and we may be going into one, but we know what the policy response will be. I mean, Bernanke outlined it in his helicopter speech in 2002. I mean, the most irresponsible speech ever made by an investment, by a central banker, right? And so the policy response will be they will print until their eyes bleed. I mean, they will do whatever it takes. I mean,
they will, Larry. They will, but I don't know that it matters. Let me tell you why.
Okay.
I think what you're doing is you're looking at this, rightfully so, from American-centric view. But the treasury market is the global bond market right now.
Right.
We got GDP, global GDP at, let's say, 120 trillion. 70% of those transactions are settled in dollars as of right now. And I would totally agree that that's declining, but it is what it is. Yeah. Right. So I spend most of my time in Colombia.
Okay.
And we're on the Colombian peso right here. And from, let's say, let's just go back to when this all went really, really haywire based on your charts in 2020.
Yeah.
The peso was trading right around, right off the top of my head, let's say 3,200, maybe 3,500, something like that to one.
Yeah.
Yep. Now we fast forward to today where the peso, I haven't looked at it lately, but let's say it's trading at 4,200, something like that.
Huh.
So what has happened is it is true that you've had consumer price inflation in the United States. Yeah. And if you are an American whose expenses are denominated in dollars, you have lost purchasing power. Yeah. But if you're a Colombian that purchased treasuries, your purchasing power has increased significantly, even relative to the local rate of inflation. And that's why when I take trips to Turkey, as an example, you go to the local coffee shop and they open up the cash register and it's nothing but dollars. Right. There's no Turkish lira in there. Yeah. It's all just dollars. Yeah. So I think we've got to look at demand from a standpoint of global demand for dollars or for U.S. treasuries, which is a dollar-based asset, a dollar equivalent, basically. And if you look at it through the global lens, look, the people in Colombia or Turkey or Argentina or whatever it is, they could care less about what the inflation rate is in the United States. Yeah. They could absolutely care less, as long as that dollar is maintaining its value relative to local goods and services. Yeah. That's the only thing they care about. Yeah. And the only way that you could get that dollar really, really going down substantially is if you somehow were to increase the deficits. Now that gets into really technical stuff that I'd like to talk about, but I'll kind of leave it at that. I think that we have to understand that global demand for treasuries, the incentive structure, I guess, is substantially different. And even outside the United States, if you're not, some person in Colombia that's maintaining your purchasing power, you're a massive hedge fund or one of these banks in the Eurodollar system, which is you're just trying to hedge out your book, and you're just trying to hedge out all your long bets. Or like my buddies in St. Barks, I've got a lot of buddies down there that used to be big hedge fund managers and whatnot. They're playing with billions of dollars back and forth. Look, they're buying the TLT not because they like treasuries long term, but they're just saying, hey, look, we got an inverted curve. The Fed's going to drop rates, and I'm going to get some serious bang on my buck with going out the long end of the curve. So there are all of these components that go into treasury demand outside of just that saver in the United States that wants to maintain their purchasing power. In fact, I would argue that's a minority.
I think you're probably right. I mean, and you're right. I do look at it very much from a U.S. point of view and a U.S.-centric point of view as compared to the alternatives, the sound money alternatives. So I hear your point. I mean, I think that this again goes a little bit back to, your time frame, my time frame. I mean, we are clearly in a deflationary impulse right now. And, buyers of 10-year treasuries could be very smart today. I mean, we'll know in a year or two. It wouldn't surprise me at all to see the 10-year trade down to 3 or 2.5 even. I would ask, let's revisit it in 3 or 4 or 5 years, because I think that, the U.S. is going to do what it has always done in the past, which is, provide the monetary accommodation necessary to keep the system running. And
Right,
that,
but I think the question there is, how would that impact demand for treasuries outside the U.S.?
right. And it
I
may
don't know that
not.
it would.
Yeah, it may not. I mean, I would say to you, though, I think in Turkey, from what I've heard, and perhaps in Colombia, I'm not familiar with Colombia, people are saving in dollars. I get it. And particularly because, they can spend them more easily, but they're probably also saving in gold. I mean, as I understand it, from the people I know who've been to Turkey, there's a lot of talk about buying gold as the way to defend oneself.
Yeah, most banks have a service there where they allow you to transfer your your savings account actually into gold.
Is that right? Okay, so they make it easier for
Yeah,
you.
the gal that was my tour guide there, that's what she does.
Yeah. How about Colombia? Is it the same situation or not?
No, they don't, but they have multi-currency accounts here. But they
Ah,
don't. I haven't seen anything where they give you that option for a spread to take. Say you got $100,000 in the bank, to just turn it into a gold equivalent.
oh, interesting. Yeah, right. So I mean, I consider that to be your other alternative, to the dollar in a world of a bunch of currencies, all of which are, pieces of paper that are losing value, kind of on a consistent basis year over year. So, and then to me, that's actually one of the remarkable things about what's going on right now. I mean, gold is kind of bouncing. I was talking about this on another podcast recently. Gold is like within inches of an all-time high. It's an all-time high in every currency in the world except the dollar.
Yeah,
And
yeah.
you don't hear anything about it, and the sentiment's pretty terrible. And I think at some point it's going to make it through this 2070 range, and I can't see where it doesn't squirt up to 2,500 to 3,000 relatively quickly, because I think that I think right now what the market is coming to grips with, and will have to come to grips with, is the notion that the soft landing isn't going to work. That there's not a soft landing coming here, and I know you agree with me on that. The problems that we've got, there's a lag between the tightening of the monetary system and the time when it affects the economy, and we've just about run out of that lag from what I can see.
Yeah. No, we totally agree on that. I think,
Yeah.
I guess the question that I would pose to you, because your argument, we basically saw it play out from 2020 to 2023.
Right.
We saw the deficits blow up, as I said on that Twitter Spaces yesterday. The national debt went from 22 trillion to 33. It's probably maybe even 34 right now over the last 3 or 4 years. So if there has ever been an argument to be bearish the United States dollar or to be bearish bonds, we just saw it play out over the last 3 or 4 years. So my question to you would be, why do we still see so much demand for treasuries in light of that? And why, during that time frame from 2019 to today, did the dollar go up?
I think the dollar went up based on just general dollar liquidity. And, to be honest with you, George, I can't answer it. Like I say, I don't really do the dollar very much. So
but I think that's a component of the bonds. I don't want to put you on the spot there, Larry, but that's my, when we go back and forth on Twitter, that's my real point is, I'm not saying that these deficits and debt ends well. I'm not saying that we can continue this forever and just ride off into the sunset printing money, and that just solves all of our problems. I'm just saying that we can't just say that, 22 trillion didn't, or 33 trillion doesn't matter, but oh my gosh, 35 trillion, holy cow, when we hit that, then that's going to be the line in the sand. I just say that, yes, this will be a problem, but we have to understand what type of catalyst we would need to see in order for it to be a problem. And then my main point, Larry, is I even if I don't really think the debt matters that much, unfortunately, as in terms of being able to issue debt for the United States. At least I don't think it's going to in the next 3 or 4 years. But that doesn't mean that we get a free lunch, right?
Okay.
Because in my view, the problem isn't necessarily the debt or servicing the debt or the interest on the debt. It's
Okay.
that the government is spending to begin with,
Right.
right? And the example I always use is a heroin addict,
Right.
right? So let's say you've got some guy that's a heroin addict and you give him a credit card and he runs that credit card up to its $100,000 limit, just injecting more and more heroin into his body, destroying his mind, destroying himself physically, and destroying his soul.
Right.
And then all of a sudden we come in and give him a brand new credit card with a zero limit.
Right.
Okay, now he doesn't have a debt problem, but he still has his main problem, which is he's a heroin addict. In fact, we just made it worse because now if you take the debt down to, let's say we took the debt down to 30% GDP in the United States. That's an even bigger problem because now the government will have an excuse to take it right back up to 70%. And it's the government spending that distorts the economy. It's the government spending that disproportionately impacts the poor and middle class negatively. That's the real problem. It isn't necessarily just servicing the debt.
I agree with you, but we're talking, I mean, they're two sides of the same coin, right? Because the spending leads to the debt, right? I mean, it's the spending that leads to the deficits, and I don't disagree. The government is acting like a heroin addict. I mean, there's no doubt about it. And yeah, I mean, I think we're saying the same thing, just with slightly different terminology. You know?
We are. It's just people get fixated on the debt being a problem. Oh my gosh, in 5 years or 3 years, the interest payment is going to be 100% of tax receipts.
Right. Yeah. So what?
Okay. Look at Japan. Okay. Look at what we've done over the past 3 years. Does that change anything? I don't like it, but I don't know that really impacts the bond market.
Yeah.
And I don't know that impacts the dollar. Might even makes it do the opposite, like we've seen in the last 3 years.
Yeah, very possibly. I mean, I think it does. I don't know. I think though. I mean, if you look at the last time we had debt to GDP like we do today, 130%. Eventually the bond market kind of revolts, and they had to do YCC, yield curve control, as you know, post World War II, and that led to the inflationary years of the late 40s and 50s that you alluded to, and so I think and I think you're starting to see that. I mean, you had a 30-year auction that didn't do very well a month or two ago. And, I think what led to this pivot more recently was the fact that the 10-year had gone from kind of the 4 level to the 5 level very quickly. I mean, that kind of reminded me very much of the gilt crisis in the UK in September of 2022. And so I think the debt ultimately does matter, George, in my view. And they care about it. I mean, we know it mattered in March of 2020 when the debt market kind of went no bid, and Powell basically came in, and this, we're saying kind of the same thing, but he came in with the ultimate put where he more or less, behaved like Mario Draghi and said, whatever it is going to take. And as you recall, I mean, they were buying corporate bonds, they were buying everything under the sun. They did TAF, they had 7 programs where they were just going absolutely nuts. That's how scared they were about the debt market imploding and about people not being comfortable holding the debt. So, it might take getting to that extreme for that kind of behavior to occur again. And that's not that's not what's going on right now. And I agree with you. I mean, 38 billion of debt or trillion of debt, 34, whatever, it's not a big difference, but at some point there's a tipping point where something breaks. I mean, and we can go through all these breaks. I mean, LTCM was a break. 2008 was a break. 2019 was a break. 2020 was a break. I mean, we've seen it. We've seen it over and over again that, the system continues. Something breaks. March of this year was a break, right? With, Silicon Valley Bank. Something breaks and they are forced to step in and provide the put, which, any way you look at it is a money print, right? I mean, the BTFP was a money print. I mean, they say it's a loan. They say they're going to unwind it. I don't believe they will unwind it. And, more or less, they were buying assets that were worth 75 cents for a full dollar. So they were saying,
when we're talking about printing money, Larry, most people would consider that in terms of consumer price inflation.
Correct.
Right.
Yeah, correct.
So if it's a transaction between 2 banks, it doesn't impact M2 at all.
No, I understand that, but But the fact that the banks are made whole allows them to go back to doing what they do, which does affect M2.
I know, but
Correct?
so if we're going to go down that path, though, and say that the BTFP was, let's say, anti-deflationary, therefore it was money printing, because if the Fed would not have stepped in, then the banks would have gone bust. And
Right.
since M2 is the liability side of their balance sheet, if
Right.
that goes to zero, then M2 money supply would have shrank.
Right.
If that's your argument, which I think is a great argument, but then you have to also understand that anything would be money printing. So let's just say that JP Morgan came in and bought the assets of the bank. Okay, that's money printing.
Absolutely.
Let's just say that they changed the regulation with mark-to-market accounting, like they did in 2009, that arguably saved a lot of the banks.
Yes.
Okay, well, that would be money printing.
Absolutely. Yeah.
as well.
Yeah.
So I don't know that we can. I think we have to define it as M2 and then ask, what's impacting M2. And I don't know that, or else we're just going to have to include everything.
I think you do have to.
The money printing basket.
Yeah, I think you do. Yeah, I feel for you, George, because I had that same thing about 2 or 3 weeks ago. It's awful.
Yeah, sorry.
No, it hangs on. I think that it's safe to say that, yes, I mean, the Fed put, by definition, becomes money printing for basically everything, because as you point out, every time they save a bank, that bank's balance sheet does not disappear, and therefore that's part of M2. So yes, I mean, the fact that we have an underlying put in the economy is the real issue, and so, I mean, this is a system, it's a flywheel that has to continue to grow, because as we all know, the other thing is, on my Twitter feed, my pinned tweet is, you can't continue to grow debt at a higher rate than you grow GDP, because the GDP is what's used to service the debt. And so there's a fundamental disconnect here in this broken Keynesian system, which allows the banks and others, to continue to take on these risks that they should not take on, and to increase debt at a rate in excess of the underlying growth of productivity and GDP, knowing that when it breaks, which it will, and it has on multiple occasions, they will be bailed out. And so yeah, I actually would go with your prior definition. All of these things are money printing in an indirect fashion.
Yeah, but so would a bank buying assets from another bank.
Absolutely. No, absolutely.
That would be money printing.
I would agree with that.
I just think what happens, Larry, and where I kind of push back against it, is when most people on Twitter hear you say that the Fed is printing money, in their mind, what is happening is the Fed is literally printing dollar bills and injecting them into the economy. Therefore, because they're looking at it from a standpoint of consumer price inflation, right? Yeah, therefore, there's going to be more currency units, like literally in people's hands out there to buy goods and services. And therefore, anytime the Fed prints money, then we should expect that to be inflationary, or from an Austrian standpoint, we should expect prices to be higher than they otherwise would have been.
You're correct.
Right? And that's what I try to disentangle, because I think people draw inaccurate conclusions when they hear people on Twitter just say the Fed's printing money, the Fed's printing money, the Fed's printing money, because they don't understand that nuance.
I don't disagree with you, and I'm being sloppy when I'm making the general concept that the Fed put leads to the creation of, or the defense of M2, which, and it is the underlying growth in M2 that in my opinion does drive the consumer price inflation. I know to some degree it's demand driven, as you pointed out, but I don't disagree that my terminology could be a little clearer because of all the mechanisms through which it goes through. But the fact,
I just say that because it doesn't necessarily mean that in normal times when risk is normal, that if the Fed increases their balance sheet, that's going to somehow impact M2. It's not even going to be anti-deflationary. It's going to be nothing.
Yeah. I might take a little bit of issue with that, because I think, it depends on how they increase their balance sheet. I mean, if, I know that there's
mortgage-backed securities or treasuries.
Yeah.
I think that's a fair point. That's a fair point.
I mean,
so if they're buying all mortgage-backed securities, then you're going to reduce the spread. Maybe the mortgage rates come down, and that could lead to more lending. Okay.
Yeah. I think there is a chance that the Fed Look, we're all saying kind of the same thing. Where I think we're getting twisted in our underwear a little bit is just in the actual monetary plumbing and all of the various ways the money flows. And I don't disagree with your criticism that I'm being slightly inaccurate when I say the Fed is printing money.
And the only reason I'm being critical is because at the end of the day, it really does matter. It's not just splitting hairs. If you're trying to figure out the probabilities of consumer price inflation or the stock market or the bond market or interest rate, this stuff matters.
I agree with that. I agree with that. But I think you would have to agree that everything I've described at a global macro level over a long enough time frame does lead to expansion of the monetary base, and it is that expansion of the monetary base which does ultimately lead to consumer price inflation. Correct?
No. I agree that you're going to have money supply increase with GDP, population, energy,
Right.
whatnot.
Right.
But I don't think the base has anything to do with it.
Really? Okay.
No, because if you look at where I'm getting that, Larry,
Yeah.
is because if you just look at the Fed's balance sheet, there's really no correlation with M2. And in fact, if you look at prior to the Fed,
whoa, slow down. I mean, let's take the 2022 example.
Well, that's one. I'm saying if you look at a long period of time, there's no, you could just flip a coin, and it is true, absolutely.
I mean, in
if
the
you look at
2022
M2,
example, the Fed balance sheet grew enormously, and M2 grew 42%. Right. So,
right.
I mean, that's pretty strong correlation, I think.
Well, during that one little teeny weeny time frame in the last 100 years, yeah, I'll give you that. But we got to look at, okay, if that is not happening 95% of the time, and it is happening 5% of the time, I don't know if we can draw a strong, correlation or causation or whatever. I don't know if that really means anything, is my point. And if you just look at the Fed's balance sheet, it pretty much doesn't do anything. It did a little bit there in 1940s, but from 1940s to 2007, it was like a nothing. Like it didn't do anything.
Yeah, no, I know.
And so I don't know how we can.
In the 70s, it didn't do much. I agree.
No, so I don't know how we can lay the blame on the Fed's balance sheet. Another example I was going to give you is, prior to the Fed, I look at a lot of the stats from the late 1800s, and from 1880 to 1895, during the gold standard, you had M2 go up by 150%. But you had about 30-40% deflation. If you look at 2008 to 2023, the complete opposite of a gold standard. This is the central bank going nuts, the deficit spending, the profligate spending, all this stuff. M2 went up by 150%.
Right.
There was no difference. It was whether we're on a fiat standard or a gold standard, the conclusion that you have to come is either the gold standard did not constrain banks at all, or the fiat system doesn't need constraining. I don't know which it is, Larry. So my point there is that M2 money supply can grow at the exact same rate that we have seen since 2008 without a central bank. Just because at the end of the day, if the banks see a loan where they can make money, they're going to make that loan regardless of whether it's backed up by Bitcoin, gold, or thin air.
Yeah, I hear you. No, there's no question that the lending is what creates the growth of the money supply. I don't dispute
so that's why I go back to the Fed's balance sheet. Not really. The puts matters because that's mentally decreasing the perceived risk. Correct. But assuming that risk is the same, or during times when risk is just kind of a constant, I don't think there's an argument for their balance sheet making a difference.
I hear you, and I accept that, and I got to think that through because it's outside of my realm of how I've analyzed it and how I think about it. I mean, you say obviously the 2022 example is a small percentage of the total time, and I completely agree with you on that. But it's a very notable example. I mean, it's a real clear, and the problem is it's like Rosie said yesterday. You can't look at one economic variable and draw conclusions from the whole picture. You know what I mean? Because there were other things going on there. There were the stimmies and so on and so forth. So
I think that's a bigger reason why we had inflation, because they were taking savings and turning it into checking. So the velocity increased with the M2 going up. that gets really interesting as well, because if the Fed was the only way that M2 went up, Larry, it meant that the Fed was buying from non-bank entities. Because if they're buying from banks, that would not impact M2
No, I know it's
at
an
all.
asset swap. I get it.
Yeah, yeah. So if they were in, so it's just open market operations. So what that tells you is that the non-bank entities were the entities that were selling. But if they had those treasuries on their balance sheet, that's basically a cash equivalent that's zero velocity. But I don't know that savings, even though it increases M2, is any different, because I don't know that someone's selling a treasury to go pay rent or buy a car or buy Big Macs, or, you know what I mean? They're just replacing one savings unit with another savings unit. So outside of the deficit spending, if the Fed would have just done that amount of QE, which would have raised M2 from a demand standpoint, I don't know that that would have moved the needle, because we're just trading one form of savings for another form of savings.
Yeah, I hear you. I hear you. And undoubtedly some of the inflation was driven, as you point out, by the supply shock, you know.
Yeah, I think it's safe to say probably half. And I would say the same thing for the 1940s. When you look at the, you know, if you look at price controls, you know, how much did that contribute to the spike that we saw up to 19%? I'd say a lot. You know, I'd say probably 80% of that spike was due to price controls and them taking off those price controls. But that supply side stuff, I don't know if it's much of the demand side stuff because of M2 going up. But anyway, Larry, I've kept you an hour and a half, buddy. I'm about ready to lose my voice. As you can tell, I've got a splitting headache. So
you need to go get some Robitussin. That stuff helps a lot. I had that. I'm guessing you had what I had about a month ago. It's awful. It's absolutely awful. So I hope you feel better.
Yeah, thanks a lot. Well, thanks a lot for coming on, buddy. I really appreciate it. It was a fun debate, and hopefully we got people thinking about this.
Yeah, you really did. You got me thinking about it. I really enjoyed it. It's a point of view I was not familiar with, and I've you know, I've grown in my respect for your view on this and some of the statistics you have. So I appreciate you bringing it up, and I will now put it into the equation in terms of how I think about all this. I mean, it's very clear. I mean, what the biggest paradigm shift for me is, it's really the put. You know, it's not really the growing of the money. And your anecdote about Kansas City, I mean, it's really the put that it's all about. You know, that's and the way that incentivizes the risky behavior, right?
Yeah, during normal times, the balance sheet really doesn't matter. The next time that we come on, Larry, maybe we can do it in a month or so. We can take it a step further and talk about the global monetary system, because we didn't talk about the BRICS currencies, the United States losing the petrodollar. All of these things, I think we have much different views on, as well, as far as the impact of the dollar. So I think that would be a fun discussion.
That's not really my area of expertise, but I'd be happy to come back on and talk about some of that for sure.
Can you tell people how they can go to your website and sign up for your email list and get that report, Larry?
Yeah, so the website is ema2.com, Edward Mark Alpha, the number 2.com. We'll have the report up there later today. I'm also on Twitter, and I'll post the report on Twitter in the next half hour or so. We write a quarterly report. If you go to the website, what you'll see is there's a place where you can enter your email, and you'll automatically be mailed each report as it comes out. We'll never spam you. We do four reports a year, and they're free.
What's your handle on Twitter?
Handle is just my name, Lawrence Lepard, Lepard. So.
Okay, fantastic. And guys, if you want to see more of these conversations in real life, you got to get your tickets to Rebel Capitalist Pro, or excuse me, Rebel Capitalist Live. And we've got Mike Green is going to be there, Larry. Maybe we can get you there. I don't know. Where do you're in Naples?
I'm in Naples in the winter. I'm in Boston in the summer. When is your next Rebel Capitalist event? I haven't been to one. I'd like to come.
Yeah, we'd love to have you come down as a VIP guest or a speaker or something. It's in Orlando, May 31st.
Okay. I may still be here, so we should definitely get together for that. Sounds like a good one.
Okay. All right, Larry. Thanks for coming on, buddy. We'll see you next time.
Okay, we'll take care. Bye-bye.